you were bringing up tax treatment when in discussion of the difference between like an LLC and and then how you can do tax treatments on top of the entity formation. What exactly do you mean by tax treatment?
So there's a thing called the check the box regulations, and let me make it real simple. The IRS, when LLCs were invented, said we don't know what to do with this, so we're going to start letting you, if you form anything other than a corporation, an Inc., the IRS will let you tell you how to treat it. And if you don't tell the IRS what to do, here are the defaults. If it's one owner, so if you have an LLC and it's just you as the owner, you are what's called a disregarded entity. You just file a Schedule C, the same you would as a sole proprietor. If there's more than one owner, so 2 to infinity, you become a partnership. But if it works for you, you can make an S election. You can say my 1 owner LLC or my 2 owner or my 100 owner LLC can be taxed as an S Corp because we see the benefit there. But the trick is the check the box regulations. This is really unique. With particularly an LLC, you get to tell the IRS what treatment you want. They don't tell you otherwise. Now, let's back that up. If you pick a corporation, the IRS tells you what's going to happen.
Okay, and what is a disregarded entity?
A disregarded entity means if you get sued for state law purposes, for asset protection purposes, for not losing your house, your car, your bank account, your LLC, for instance, exists. It's an absolute shield. They can't walk through it, provided you're not committing crimes or frauds, right? If you're doing what you're supposed to do, your LLC blocks you from losing any more money than what you put in the LLC. But for the IRS purposes, they say we don't see an LLC. We see just you. We disregard your LLC. We tax you as a sole proprietor. So if you had a DBA and then you formed an LLC, the IRS says, we didn't see you do that. You're just a DBA for our purposes.
So basically the income that you're making in your LLC rolls into your personal income.
That's right. It comes straight to you. And for accounting purposes, there is no, you have a separate bank account, but the IRS says it's just you.
Just you.
So the money you pull out, you can't pay yourself a salary. This is very important, actually. If you're a sole proprietor, if you file Schedule C, you cannot pay yourself a salary. You take what's called an owner's draw. Now, that doesn't mean you can't say, I'm going to take out $4,000 a month. You can take out $4,000 a month, but you cannot call it a W-2 wage and give yourself a W-2 and call it a salary. The IRS says if you make $100,000 of profit, you are taxed on $100,000. I don't care if you took $10,000 out of the business to pay yourself or $150,000 out of the business to pay yourself. You are paying $100,000 on the business's profits, regardless of what you do with the money.